Welcome to Module 2 of uh, this course. So, Module 2 is all about the foundational business finance. So, the first thing I want to talk about is to go through the different structures you have in starting a business. So, there are three basic structures. One, as a sole proprietor. Secondly, you can start as a partnership. And finally, as a corporation. So as a sole proprietor, it's typically one owner. So it's one person setting up a shop and starting a business. As a sole proprietor, you have a separate entity for accounting purposes. What that means is you have to set up your own books and accounts uh, specifically for the business. So you want to keep records specifically for this business, tracking all your income and all your expenses. As a sole proprietor, you don't have a separate legal entity that is different from the owner. So essentially, you are the business. So everything you do in the business is going to be reported under your name. So this is, in some ways, a disadvantage. You also have unlimited liability. So unlimited liability, again, is a disadvantage. It increases exposure for you as a business owner. So if you're under any sort of lawsuit, if you're in some kind of trouble with your business, your personal assets may be exposed. So that is the issue with setting up a structure or a business as a sole proprietor. A lot of the business risk, though, you can take care of that with insurance. So you can get a business insurance that will take care of risk associated with your business. So that is how you mitigate some of those risks. You also have the limited life. So limited life means if anything happens to the owner of the business dies. In other words, as a sole proprietor, let's say something happens to you, maybe loss of life, then the business dies. So that's why, as a sole proprietor, that business structure has a limited life. The owner is taxed on profits. So as I mentioned before, all the profits from the business will be reported in your personal tax return. So there's a business schedule in your personal tax return where all of the income is going to be reported. The next business structure is a partnership. So partnership is when two or more people come together to start a business. So that is the only difference between the partnership and the sole proprietorship. Every other attributes are essentially the same. In other words, you need to set up a separate entity for accounting purposes. A partnership is not a separate legal entity from the owners. There is no unlimited liability. I mean, in Ontario and in Canada today, it's possible to set up limited liability partnerships. But what that means is there has to be a general partner that has essentially unlimited liability, but there may be some limited liability partners. So that is possible under some circumstances. Again, there is limited life. If one of the partner leaves or something happens to one of the partners, that partnership dies. So you have to create a new partnership. So again, that is a disadvantage, the fact that it has limited life. In this case as well, the owners are taxed on profits. So once a partnership provides their profit and loss account, all of that is going to be allocated to each of the partners, and each of the partners will now take that information and report in their personal tax return. So again, as owners, as partners, you are taxed individually on the profits from the business. The last structure we're going to talk about is the corporations. So this is again you can have one or more owners for a corporation. All it takes is to register that corporation either with Corporations Canada if you want to register it federally, or you can register it with a province. If you're in the US, I think there are other ways you can register different types of corporations. So corporation gives you uh, this special advantage of having a separate entity for legal purposes. Also, with the corporation, you create a separate entity for accounting purposes, so you have to maintain books and records for the corporation. But the biggest advantage is the fact that you have a separate legal entity, which is different from the owners. So this entity now stands on its own. It is recognized by the government as a legal structure, and because you have that entity, the corporation essentially has limited liability as well as unlimited life. So, limited liability simply means that if anything happens to the corporation, your personal assets are not exposed. So, let's say there is a business failure, and the corporation or the business is owing hundreds of millions of dollars to people. Those creditors can only go after the assets in the corporation, so your personal assets will be protected. Unlimited life, we talked about that. So with a corporation, you have unlimited life. So that means the corporation can exist forever. So because corporations are owned by shareholders, individual, you have the ability to transfer those shares to others. You can sell the shares to third parties who can buy and then take over the company. You can transfer the shares to your kids. So corporation is ideal for estate planning. And so that's why corporation has a limited life, and that's why you have a lot of big companies that have been in business for hundreds and hundreds of years. Finally, the corporation is taxed on its own profits. So there is a different tax structure for corporations in Canada. Typically, the tax rates in corporations are much lower than the tax rates individuals pay. So for corporation, the average tax rate is about 15 to 16%. So this is a summary of what we just discussed for all the different business structures. As you can see, a lot of yes, yes, yes in the corporation. So that is the ultimate business structure that you should aim for. When starting a business, I always encourage everyone to first start as a sole proprietorship. Again, it depends. It depends on what your current situation is. But if you have a regular full-time job, it may make sense to start as a sole proprietor. And the reason for this is you don't want to set up structures and then discover a few months later that you don't love the business or you're not interested in the business. And then you want to now start dismantling structures. The second point is because corporations are a little bit more expensive to maintain. You have to file a separate tax return for the corporation. Typically, the tax returns for corporations are more expensive to file compared to just a personal tax return. So it is always best, particularly when you're starting, to choose a structure that is simple, and so the sole proprietorship will meet some of those needs. So now let's go through some of the foundations of business finance when it comes to understanding the language of business. So these are the four building blocks of business. So we typically have the income. Income is what comes in. So once you sell your product and make some money, you get some income. Expenses is what goes out. So all your business expenses related to generating revenue in the business um, has to be captured. So that is a second building block. The third building block, which shows up on the balance sheet, is your asset. Asset is what you own or what the business owns. So if the business owns a building, then that is an asset. If they own motor vehicle, that is an asset. So anything they own, computers, people, your staff, all of those things are considered assets in the business, because asset is what enables you as a business to generate income. The fourth building block is liabilities. Liabilities is what you owe. So that is what the business owes. And and so liabilities again is something that shows up on the balance sheet. So when you look at the financial statements, so you find the profit and loss. In other words, is also referred to as the income statement. So the profit and loss is a statement that shows your income and all your expenses. At the end of the day, if you take all the expenses and subtract that from the income, you may end up with a positive balance, which is now profit. If it is a negative balance, then that is a loss. If you have a loss, you pay no taxes. If you have profits, you're not taxed on the profits. On the balance sheet side, you find the assets, the liabilities, and the equity. So assets will now show all the stuff that the business owns. Liabilities will show all the debt that the business owns. Then you have the equity. Equity is the capital that is injected by the owners of the business. And equity again is represented by net worth. And so you see in the formula there how we calculate net worth. So your net worth is your assets minus your liabilities. And net worth is how we track the value in your business. So let's go through one of these building blocks and go through some ideas on what you need to do once you start your business. When it comes to income, you want to build multiple streams of income within your business. So that is so important. I mean, you may think, or when you start a business, you may be wondering, how do I build multiple streams of income within one business? So that is possible, and that is what you should always consider. Let's say, for example, you open a retail store selling clothing. So, how do you build multiple streams of income in a retail business where all you sell is clothing? Right? So, people walk into your store and they buy directly from your store. Let's say you have a physical location. So, that is one stream of income. And people are buying directly from the store, they come and they buy. You can also set up an online store. So that's another stream. So people that buy online and you ship to them. You can you can run events. You can run events showing people the best way to use the stuff that you sell. And you may charge people to attend the events. Then that becomes a different stream of income. You can you can do a few things within the business to generate. You can set up a membership platform and say, okay, if you're a member of our store, then maybe you can shop at our store at a discount. And you get people to pay for membership to be part of an exclusive group of people that shop at your store. So that is another way you create revenue. So there are so many ideas you can explore within a single business to create different or multiple streams of income. And the reason you want to do that is so that you protect against risk. So if one stream of income is impacted by certain risk, just as we had with COVID, you can still generate revenue from other sources of income that you've created. So that is so important. Also consider creating system dependent income. So what that means is look for ways to add income streams that do not necessarily depend on you showing up. In other words, this is more like creating passive income within your business. So you want your business to be able to generate income while you are sleeping. So the good rule of thumb is to try to have 50% of your income system dependent and the other 50% dependent on you showing up or maybe on your employees showing up. So this is something to consider, and this is how you build a valuable business. So building block number two, expenses. So you want to keep your expenses below income. So that seems to be obvious, but I mean there's so many businesses that still don't do this. People spend more than they're making. We've seen it in personal finance where individuals spending way more than they're making. So that's the reason why consumer debt is so high. So you have to figure out a way to keep your expenses below your income. And you do this by using budgeting tools, by monitoring your expenses on an ongoing basis. So on the building block number three, assets, you want to focus on building assets that grow in value. So you need to understand the difference between assets that grow in value and assets that depreciate in value. So as a business owner, you try to pay attention to that to the assets that grow in value and invest and look for ways to enhance those asset values. So for example, if I have a business, your business is an asset. Now you have to start thinking of ways to make your business more valuable. So this will include things like adding different streams of income, increasing your income, increasing automation, building a list of paying customers, and even a list of potential customers. And so all these systems you build within your business can make your business more valuable, can increase the asset value of your business. If you have a building that you own, you may consider things to do to make that building even more valuable. Are there spaces in the building that you can rent out to generate more income? What else can you do? What else can you use the building for to enhance the value of a business? So, and again, don't forget the importance of the customer list. So, if you start a business, it's so important to track and to keep a list of your customers because at the end of the day, one of the reasons people buy businesses these days is the fact that you have a valuable customer list. If you think about why Facebook bought Instagram, is because of the users that Instagram had, right? And so Facebook was essentially after the people on that platform. So it's the same thing with your business. So you need to grow a list of customers. You need to work on ways to continue to keep them engaged and to continue to keep them to come and buy from you over and over again. So the final building block I want to talk about is liabilities. So liabilities is what you owe. So think of ways you can employ financial leverage. Yeah, it may not be necessary for every business, um, but where relevant, use it because it enhances the return on your business. It allows you to grow your business, to triple your business, double your business, 10x your business. So it is important to employ leverage as much as you can and to do it smartly. It's important to understand the difference between productive debt and non-productive debt. And the way I explain this is essentially based on taxes. Can you write off the interest when it comes to taxes? In other words, is the interest on the debt tax deductible? So you want to employ leverage and you want to use debt that is directly used to generate income in the business, that is directly used to buy business assets. So anytime you're incurring debt, make sure that that debt is directly related to your business in one way or the other. And if you do that, then that debt is not productive debt because that debt in some ways is helping you generate business revenue. So that is what you want. Non-productive debt is mostly consumer debt. and so you want to keep that at as minimal as possible, um, just because the interest cost on that is not eligible to be written off as a business expense. So now I want to talk about cash flow and cash flow planning. So cash is not the same as income. So this is often confusing, particularly for people that don't have a business background. So the fact that you received $100 cash from a customer that paid you for one of your products does not necessarily mean that you have income of $100. So when it comes to financial accounting, if you're doing your accounting on a cash basis, then yes, maybe your cash will not be the same as your revenue. Uh, Once you take all your cash inflows and subtract all your cash outflows, then the cash that is left may be the same as your income or profit for tax purposes. But for financial accounting purposes, that is not necessarily the same. So that's why you may have businesses that show profits, but they have little cash. It's also possible to have businesses that have lots of cash, but they are they don't show a profit. Is a business that generates loss. So so that is a good distinction to know that cash is not necessarily the same as income, particularly when you're using the accrual basis of accounting, which is what we use for tax purposes when it comes to a corporation. So cash is king. So we've all heard this term, cash is king. One of the reasons why businesses fail is due to lack of cash. Is a big reason why a lot of businesses fail. And so you need to watch over your cash like a hawk. You need to keep a good eye on the cash just to make sure that you're feeding your business the what it needs to continue to survive. And so businesses need cash, and there are a few ways you can improve cash in your business. So one is to keep a healthy gross margin. So gross margin essentially is your revenue, and from that revenue you subtract all the costs directly related to generating that revenue. So let me give you an example. Let's say I sell clothing online. All right, I have an online store where I sell clothing. So what are the costs necessary for me to make that sale directly related to making that sale? So obviously I have to buy my inventory, the clothes, or I have to make them. If I make them myself, then all the cost of making that piece of clothing is now a relevant cost. If I'm selling them exclusively through an online platform, then the cost of using that platform may be a direct cost as well. In here, I'm not going to consider marketing or advertisement because that is not directly related. It helps in selling, but is not a direct cost. So, so that is how you determine your gross margin, right? So you take your revenue, you subtract all the costs related to generating that revenue. So the difference you have is now your gross margin. Now, to calculate your gross margin percentage, you take that number and you divide it by your gross revenue. So that's how you get your gross margin. That's how you get your gross margin percentage. And ideally, you want that gross margin percentage to be about 50% or more, but you don't want it to be below 40 or 30%. It's going to be different for different types of businesses, and so you want to keep your gross margin as high as you can. And the reason for that is a healthy gross margin will allow you to conserve cash, will allow you to have enough money to take care of all your business operations. You got to manage your cash flow closely. is so important. So you got to understand what is coming in on a cash basis, what is going out. You got to figure out a way to structure your payments, structure your receipts, so that you always have enough cash. Think of ways to even set up overdraft in your bank account and line of credits that you can use when you're running low on cash. You got to understand all the different seasons in your business. There may be seasons where you get a lot of cash. There may be other seasons where you don't get as much cash. So you got to figure out what to do in those times when you don't have enough cash for the business. Try to get paid upfront. You don't want to be chasing your customers or your clients to collect payment. It's a waste of time. It's an unnecessary cost, particularly if you have to hire someone to do it, and it stretches your cash as well. So you want to get paid upfront before you provide a service or product. You want to keep a cash reserve. If we've learned anything from COVID, it is the importance of having backup cash. Backup cash to keep the business going even when sales dry up. So you need to build a cash reserve. It is often advised to have for businesses to have cash reserves that can sustain your business for at least 6 months, but ideally for 12 to 18 months. Where possible, extend your payables. Um, Take advantage of all the payment terms in your invoices or provided by your suppliers. If they allow you to pay 30 days after they provide the service, yeah, why not? So stretch and pay them on the 30th day. Spend only on essentials when it comes to your business. Only spend on things that are super essential, and that way you keep your expenses below your income and you conserve cash. Also important to learn the language of business. I mean, I talked about this briefly when I introduced the building blocks of business finance. So it's important to understand the language of business. You need to understand accounting. You need to understand how to read financial statements. I encourage you to take a foundational course on accounting so that you know how to read financial statements. You know what those numbers mean when you're looking at your finances. Because if you do, then it's easier for you to tweak. It's easier for you to find areas to improve to get more financial leverage. So, always important to understand the language of business, and the language of business is accounting. Bookkeeping and record keeping is so key. Um, so, CRA requires you to keep proper records of all your transactions, to keep documents of all your contracts. It's so important to have this because if you don't, you may have issues with the CRO. From time to time, businesses are selected for audit, and once you're selected to be audited, you will be asked to provide documentation. You will be asked to provide a list of transactions. And if you don't keep this and maintain it properly from day one, it becomes a challenge for you to respond to some of these requests from CRO. And with technology these days, it's so easy to do. So we typically use QuickBooks Online, and it's an accounting software online, very cheap. You get it, you connect all your business bank accounts, and you get all your transactions, and you allocate those transactions. So with a software like QuickBooks Online, it's so easy to generate profit and loss statements. It's so easy to generate financial statements. It's so easy to even analyze your financial statements to learn and to get some deeper insights into your business. Taxes, as I discussed earlier, if you have a corporate structure, you pay corporate income taxes, and those tax rates are at about 15 to 16%, very low compared to personal taxes. If you have a sole proprietorship or a partnership, then your income is going to be reported in your personal tax return, and you're going to be taxed personally based on your marginal tax rate. So if you have high income over $200,000, then your marginal tax rate is going to be over 50%. If you have a business, you may be required to set up a sales tax account, HST, PST, GST, depending on the province where you're located. So these tax accounts are separate from your corporate tax accounts, so you need to set that up with CRA. So typically, if you have revenues over $30,000 per year, then you're required to charge HST. If you're less than $30,000, it's optional for you. You can decide to register for HST. It just introduces an additional compliance step because you now have to file a separate tax return for HST. All right, so this is where we end this model. I'll see you in the next model.